Hi guys, this is Sunny Spark Learning, and today we will be looking at adjustments in accounting. In accounting, we have 4 different adjustments, which helps us record transactions in a right way and in the correct time period. So these adjustments applies to grade 10, 11, and 12. It doesn't exclude anyone in accounting. So we have 4 types, which are prepaid expense, income received in advance, accrued income, and accrued expense. So now, with starting with the first one, which is the prepaid expense. That is when you pay for an expense more than you should have paid. You pay more than you should have paid. For example, on the income statement, let's say for the insurance amount. Insurance is the expense of the business, right? So let's say you decide to pay the yearly amount for insurance. Then the insurance company charges you, let's say 20,000 for the whole year. Then you pay 23,000. For you to know that this is a prepaid expense, you have to calculate. You have to know how much the insurance company have charged you and how much you have paid. If you have paid more than what the insurance company have charged you, that means it is prepaid expense. You have paid more than you should have paid. Okay, so to define this, I'll say this is when you pay for an expense more than you should have. More than you should have paid. This means you pay more than the amount you must pay. I give an example of the insurance company that it charges you 20,000 per annum. Okay, so you pay when the insurance company charged you 20,000, but you paid 23,000. This tells you that this is a prepaid expense because they charged you 20,000, but you have paid more than 20,000. What's the difference? The difference is for you to find the difference, you'll say 23,000. You take the bigger one minus the lesser one. Minus 20,000. Then you get 3,000. So you paid more by 3,000, which means this amount of money must be refunded back to you. Okay, so now let's move to number 2, which is income received in advance. With this one, it's similar to prepaid expense, but the opposite. By the opposite, I mean that when you define the prepaid expense, you say this is when you receive more than you should have received. In prepaid expense, we said this is when you pay more than you should have paid. Now, in the income received in advance, this is when you receive an amount of money, but you receive the amount of money that you receive, it's more than the one you should have received. Okay, so let's define this. This is when you received more than you should have received. Okay, now here let's give an example of rent income on your income statement. This is an example. So on the rent income, let's say you have a business, then in your premises you have an extra space which you do not use. You don't have to, I mean, which have a space that you don't use. Okay, so when dealing with this example, with the space that you are not using, you decide to rent the space out to someone else who would like to operate their business in your premises. Okay, so let's say you charge them maybe 80,000 pay for the whole year, which is 12 months. Okay, now that person doesn't pay you. That person decides to pay for the whole year but doesn't pay you exactly the 80,000. He or she pays more than 80,000. Let's say, for instance, he or she pays 90,000, but you have charged him or her 80,000, but you have received 90,000. Since you are the one receiving in this case, it means you have to get the difference, which is 90,000 minus 80,000. You'll get 10,000. The difference is 10,000 in this case. You have to take this 10,000 and refund that person back, so that will be left with the 80,000 that we charged him or her. Okay? So now let's move to the third one, which is accrued income. With accrued income, the word accrued simply means outstanding. It means you still have to pay or you still have to receive. In this case, we are talking about income, accrued income. It means this is an outstanding income. You still have to receive this amount of money. You have not yet received, or you have received, but you received less money. Okay, so you have to, there is a difference that you have to receive in order to ensure that the amount of money that you've received is in full amount. Okay, so for example, okay, let's define this first. Let's say this is income. Okay, this is when you received less amount of money, because we're talking about money, less amount of money than you should have received. I'll give an example of the rent income again. So since this one, it says you received less than you should have received, it means since we charged the tenant, the person who rents our space is called a tenant. Okay, so since we charged this tenant 80,000, I'll take it again. Since we charged this tenant 80,000, we as the business, at the end of the year, we expect him or her to pay this full 80,000. But what she does, or what he does, what the tenant does, she pays less, which means, let's say in this case, they paid 70,000, which means we didn't receive our full 80,000 that we charged the tenant. We received less, which is 70,000. Okay, what this means? It means the person still owes us an amount of 10,000 in order to make it a full 80,000. Okay, so now when you record this kind of adjustments on the income statement, you will say you will find the difference. Then you take the amount you got on the trial balance. Let's say in this case we've got what okay, let's say 70,000, because that's what they paid. Then you'll get information explaining how this person paid, which will tell you that the person paid less. Okay, then you will say, for you to get the final answer, you'll say plus 10,000, which is the difference for us to get 80,000. Okay, so accrued income, it's an outstanding money that you must receive. The money that you still have to receive. You haven't received the full amount yet. You have received some money, but not the full amount of money. Okay, so now let's move to number 4, which is accrued expense. This is similar to accrued income, but the opposite. How? In accrued income, we were talking about income. We were talking about receiving. But in this case, we are talking about expense. So an expense, you'll define it in this way. This is an expense that you have not paid yet. Okay, so with this one, let me give you an example of water and electricity. Okay, so with water and electricity, we know that this is a compulsory expense to the business. A business cannot operate without electricity and water. Okay, so with this one, let's say you owe an expense of, or you have to pay an expense of 100,000 for water and electricity for the entire financial year, which is 12 months. Okay, but at the end of the year, you have found out that you haven't paid the full amount of money. Let's say you only paid 80,000. Okay, so it means for you to say you have settled your whole year water and electricity bill amount, which is 100,000, you have to pay the whole 100,000. But what you did is that you paid 80,000, of which when we calculate the difference, you get 20,000. It means you still have to pay 20,000 for you to have paid the full amount at the end of the year of 100,000. Okay, so it's similar to accrued income, just that in this case the difference is the income, and in this case is expense. So in the income we talk about receiving, but in the expense we are talking about paying outstanding cash that you must pay, okay, such as water and electricity. Okay, so now the idea under this accrued expense is that you use something now, but you pay at a later stage. Okay, now this is the four adjustments, the four main adjustments that you have to know for you to ace the financial statements in accounting. Okay, so if you don't know these four adjustments, I'm telling you, accounting is going to cook you. Okay, so without further ado, please like, follow, share, subscribe, refer a friend to this learning academy so that we get distinctions, all of us. Okay, now on the next video I'll do two adjustments, giving giving you an example to one of these adjustments or two of them. Okay, so like, share, follow, subscribe,